Welcome to today's deep dive, everyone. Before we get into the thick of it, please make sure you like the video, subscribe to our channel, and comment below with your own opinions as we go. We really want to hear from you.
Absolutely. It is always great to read through what you all are thinking.
Yeah, it really is. So today we are digging into a highly specific snapshot of the global economy. We are looking at the gold and silver market news bulletin for the evening of June 21st. And joining us today to unpack all of this is senior market analyst Michael Anderson. Thanks for being here.
Oh, thanks for having me. I am really looking forward to getting into the numbers with you today.
Same here. So let's just lay out the baseline for everyone listening. Gold is supposed to be the ultimate safe haven, right?
That is the traditional rule, yes.
Right. When the news cycle looks grim and global stability feels like it's falling apart, gold is supposed to surge. You buy it when the world feels like it is on fire.
Exactly.
But right now, despite some massive, undeniable global instability, gold is just, well, it is completely stuck in the mud. The market is effectively frozen.
Yeah, it really is. The data in this June 21st snapshot shows a market trapped in a holding pattern. We are looking at a precious metals environment that is just characterized by extreme caution.
Just waiting and watching.
Right. Observation and a profound lack of directional motivation. That upward momentum that defined the previous months, it has simply vanished.
I am looking at the cold, hard numbers from this bulletin, and what stands out isn't a massive crash. It is this microscopic, incredibly sensitive trading range. Gold has lost its momentum and is just hovering right at $4,150 to $4,160 per ounce.
Yeah, right in that tight pocket.
And silver closed at $64.88, but it opened slightly lower, around $64.40 per ounce. It is a total stalemate.
Analysts call this a sideways consolidation. The shock decline we witnessed prior to this bulletin has basically leveled out into a flat line.
So our big question today, the whole mission of this deep dive for you listening, is to figure out why. Why are gold and silver suddenly paralyzed, and what does this mean for your own financial awareness?
Well, to understand why the market feels paralyzed, we have to look at the massive macroeconomic anchor dragging the market down right now.
Okay, let's get down to brass tacks. What is the anchor?
Everything begins and ends with the Federal Reserve.
The absolute elephant in the room. But I'm struggling to square the circle a bit. Recently, the Federal Reserve held a meeting where they actually kept interest rates unchanged.
Right. They did pause the hikes.
So my instinct says that a pause should be a green light. The market should breathe a sigh of relief and start moving upward again. Why did the market react so poorly to a pause?
Because markets are forward-looking mechanisms. I mean, they rarely trade on what happened today. They trade on the probability of what will happen tomorrow.
Okay, makes sense.
So while the Federal Reserve did pause rate hikes in that specific meeting, the message they released alongside that decision was far tougher than anyone on Wall Street anticipated.
They came out swinging.
Exactly. They adopted a heavily hawkish tone.
Let's unpack the mechanism behind that term, because we hear hawkish thrown around constantly in the financial media.
Right. A hawkish stance simply means a central bank is prioritizing the fight against inflation above all else.
So they want to slow the economy down.
Yes. Usually by signaling that interest rates need to stay high or climb even higher to choke off excessive spending. And the detail in this June 21st bulletin that really spooked the market involves the internal projections of the Federal Reserve members themselves.
What did those projections say?
Out of 19 Federal Reserve officials, 9 of them explicitly stated they believe further interest rate increases are still required before the end of the year.
Wait, 9 out of 19?
Yeah, nearly half.
That isn't just one or two rogue outliers being overly cautious. That is practically a coin flip within the most powerful financial institution in the world.
It is. And it signals that they are not done squeezing the broader economy. That near majority consensus is a terrifying prospect for traders who were, betting on rate cuts.
So when the market digests that data, what is the immediate fallout?
2 things happen immediately. First, the United States dollar index begins to recover.
And because gold is priced in dollars globally, a stronger dollar instantly makes gold more expensive for investors using foreign currencies.
Precisely. Demand naturally drops. But the second factor is the real killer here. Short-term United States bond yields surge.
Let's slow down and look at the causality there, just to make sure I am visualizing this correctly. Why does a hawkish Federal Reserve suddenly make government bonds so incredibly attractive that it pulls money away from gold?
Well, think about the fundamental nature of holding gold. It is a spectacular store of value. It is rare, it is beautiful, and it exists outside the banking system.
Right.
But holding physical gold does not generate a yield. It doesn't pay you a quarterly dividend. In fact, it often costs you money to store and insure it.
Yeah, you have to pay for the vault.
Exactly.
Yeah.
A government bond, on the other hand, is a promise to pay you a specific, guaranteed amount of interest over a set period of time. When the Federal Reserve signals that rates might go higher, the government has to offer higher interest rates on new bonds to attract buyers.
Okay, I think I see where this is going. We are dealing with a massive shift in opportunity cost.
That is the core of it, yeah.
Let's use an analogy for everyone listening. Holding gold right now feels a bit like owning a rare, highly valuable painting. It is incredibly safe, and it holds its value well over decades.
A great asset.
But that painting hanging on your wall isn't putting cash in your pocket every month. Meanwhile, these surging government bonds are acting like the world's most aggressive, high-yield savings account.
That is a perfect way to look at it.
So, if the government is offering a guaranteed risk-free return of 4 or 5%, investors are essentially being paid to take their painting off the wall, sell it, and park their cash in that high-yield account instead.
The opportunity cost of holding the painting has simply become too painful for large institutions to justify.
It is just basic arithmetic for them.
Right. When bond yields are low, holding your wealth in gold makes perfect sense because you aren't missing out on much elsewhere. But when those yields surge, money acts like a current.
It flows to where it gets treated best.
Exactly. Right now, that current is violently pulling capital away from non-yielding assets like gold and rushing it toward those guaranteed yield-bearing government bonds. The bulletin makes it crystal clear. The United States dollar and short-term bond yields are the absolute dictators of this current market.
Okay, so that explains the macroeconomic gravity pulling prices down, plain and simple. But it brings me to a massive contradiction, and I think a lot of people listening will feel the same way.
What is the contradiction?
The historical purpose of gold is to act as the ultimate insurance policy against geopolitical disaster.
Yes, the safe haven.
And if you look at the headlines, the Middle East is incredibly volatile right now. There is a massive amount of global instability. My instinct is that this fear should be acting as a counterweight, pushing gold prices right back up.
It seems like it should, doesn't it?
Yeah. Why is the safe haven effect failing to do its job?
We are watching a fascinating real-time demonstration of how algorithmic trading models and large institutions process conflicting information.
Conflicting how?
The news cycle coming out of the Middle East right now is a perfect storm of mixed signals. And those signals directly impact the inflation data that the Federal Reserve is watching so closely.
Oh, I noticed that in the sources. The bulletin highlights a few calming factors that are actively deflating that safe haven premium.
Yes, there are rumors of the United States and Iran preparing for back-channel negotiations in Switzerland.
And whispers of a potential temporary ceasefire in certain conflict zones.
Right. So follow the chain reaction of those whispers. If those negotiations yield even a temporary pause in hostility, the immediate result is a cooling of global oil prices.
And oil is the lifeblood of the global supply chain.
Exactly. If oil prices fall, the cost of manufacturing, shipping, and transporting everyday goods begins to fall. That decreases overall inflationary pressure.
And if inflation lowers, the Federal Reserve doesn't need to be as hawkish. They wouldn't need to raise rates. The pressure comes off.
You've got it.
So the mere rumor of a diplomatic meeting in Switzerland cools down oil, which cools down inflation expectations, which ultimately weakens the panic demand for gold.
That is the exact causal loop. However, the bulletin also explicitly highlights the escalating side of the geopolitical equation.
Because it isn't all good news.
Far from it. There are profound ongoing concerns about the Israel-Hezbollah-Lebanon conflict spreading further. The sources also point to regional instability, keeping shipping businesses extremely cautious around the Strait of Hormuz.
Which is one of the most vital oil choke points on the planet.
Exactly. So oil prices might not actually fall significantly.
This is where I have to push back a bit on the market's seemingly blind optimism.
Fair enough. Go ahead.
If the reality on the battlefield is completely unclear, and if a massive percentage of the world's oil supply is still at risk of disruption through the Strait of Hormuz, aren't investors being incredibly naive?
It does look that way from the outside.
It feels like they are prematurely stripping gold of its safe haven status while the match is still hovering, less than an inch above the powder keg. If oil supplies actually get hit, inflation spikes again, and this whole calming narrative falls completely apart.
It feels like a massive disconnect, absolutely. But you have to view this through the lens of modern finance.
Meaning the algorithms.
Right. Large institutional players and algorithmic trading models do not operate on emotion. They operate on probability and present-day mathematics.
They prioritize quantifiable math over unquantifiable fear.
Perfectly stated. The Federal Reserve's interest rates and the exact yield of a United States bond are absolute mathematical certainties happening right this second.
While a potential escalation in a conflict or a theoretical disruption in the Strait of Hormuz is just a probability happening tomorrow.
Yes. In the short term, the math of the Federal Reserve overpowers the fear of the battlefield.
Wow. They are entirely ignoring the geopolitical risks then.
No, not ignoring them. They're simply calculating that the opportunity cost, that daily loss of not holding those high-yielding bonds, is too high a price to pay just to hide in gold while waiting to see if a theoretical missile strike disrupts an oil tanker.
That is a fascinating psychological insight into how Wall Street actually operates.
It is cold, but is how the money moves.
So now that we understand this massive, invisible tug-of-war between the macroeconomic math and the geopolitical reality, let's look at how this is physically manifesting on the charts for the week of June 21st.
Let's do it. The bulletin gives us a very clear map of the battlefield.
Let's start with the sentiment surrounding gold. The consensus seems incredibly heavy right now.
It is, according to the market survey experts cited in the bulletin. Roughly 70% of them lean toward a downward bearish scenario in the short term.
70%. That is a staggering majority betting on a drop.
The overarching belief is that gold has temporarily lost its safety net.
The bulletin outlines specific psychological milestones we need to watch, right?
Yes. There is a near-term floor, a support zone, where buyers might step in to stop the bleeding. For gold, that zone is between 4,120 and 4,140.
But the warning in the sources is clear. If that floor collapses, the market is likely going to test a massive psychological round number.
Yes, the 4,000 mark. Round numbers hold a very strange power over traders.
Why is that? Just human nature.
Pretty much. When a major asset approaches a massive even number, it acts like a magnet. If that near-term floor breaks, algorithmic triggers and panic selling often accelerate the drop until it hits that next major psychological baseline.
And what about the ceiling above gold?
It is incredibly thick. The resistance zones are sitting around 4,200 to 4,230, with very strong resistance at 4,300.
So without a brand new, unexpected catalyst, like a sudden collapse in bond yields, the likelihood of a strong rebound breaking through that upper resistance is very low.
Right. The hawkish news from the Federal Reserve has already been priced into the market.
Now, the June 21st numbers for silver tell a slightly different story, don't they?
They do. It is still moving sideways, but the bulletin explicitly notes that silver is actually maintaining a much better structural foundation than gold right now.
The floor beneath silver appears to be thicker. Support is between 63.5 and 64, and resistance is up at 66 to 67. It seems to be holding its ground against the macroeconomic gravity a bit better.
That resilience comes from silver's unique dual identity.
Let's explore that. Gold is primarily a monetary asset and a psychological safe haven, right?
Exactly. And silver shares those monetary traits, but it is also a massive, vital industrial metal.
Oh, right. It is deeply embedded in manufacturing.
Yes. Electronics, solar panels, electric vehicle components, medical devices.
So it has an entirely separate demand engine. Even if investors stop buying silver as a financial hedge, factories still need to buy it to build solar panels.
Precisely. That underlying industrial demand can act as a cushion when the monetary factors turn violently negative.
Okay, but the bulletin is careful to note something important here. While this industrial buying pressure provides a stronger floor, it is nowhere near aggressive enough right now to cause a sharp upward spike in the price.
Now, it prevents a crash, but it doesn't spark a rally.
Which raises a really critical question for you about how these two metals interact. If silver has a better underlying foundation right now due to its industrial use, is it truly standing on its own 2 feet?
What do you mean?
Let's say the massive psychological floor beneath gold finally collapses and gold goes into a free fall down to 4,000. Does silver survive that? Or is silver just a smaller boat tied to the massive anchor of gold?
It is absolutely the smaller boat tied to the anchor.
Wow, okay.
That is the harsh reality of the precious metals market. Silver has some resilience, and if it can hold that 64 level, its medium-term trend isn't entirely negative. But the macroeconomic gravity of gold is overwhelming. If gold violently tests its lower boundaries, it will inevitably drag silver down with it, regardless of how many solar panels are being manufactured.
Both metals are essentially hostages to the United States economy right now.
Yes, they need a weakening dollar or dropping bond yields to break out of this stagnation. They cannot defy the Federal Reserve forever.
So let's bring this directly to the person listening right now. With all this sideways movement, the looming threat of floors collapsing, and 70% of short-term experts predicting a downward slide, it is incredibly easy to feel overwhelmed by pessimism.
I can certainly understand why investors would feel that way.
How should an investor navigate this specific snapshot in time?
We need to zoom out. The most crucial takeaway from the June 21st bulletin, the actual good news hidden beneath all this short-term anxiety, is that the long-term upward cycle of gold has not been broken.
That is a huge point. The multi-year structural trend is still entirely intact.
It is. The bulletin lists several massive pillars keeping that long-term structure standing.
Right, like the underlying unresolved geopolitical instability. We also have creeping concerns about long-term global economic growth.
Yes, but the most fascinating pillar to me is the behavior of the world's central banks.
Oh, this is the ultimate counterindicator to all the short-term panic.
Exactly. While retail investors and day traders are sweating over every microscopic move in bond yields and panicking over the Federal Reserve projections,
The largest and most powerful financial institutions in the world, the central banks, are quietly and steadily continuing to accumulate massive amounts of physical gold.
they were playing a generational game. They are entirely unfazed by the daily volatility of the United States dollar.
Okay, so knowing that the long-term upward cycle is still alive, but the short-term reality is this terrifying sideways chop, what is the actual playbook here?
The bulletin provides some highly specific strategic warnings for anyone trying to navigate this environment.
What is the primary rule?
Emotional discipline. Avoid panic selling. Do not make reactionary trades based on fear, particularly at the beginning of the trading week when market liquidity is low and price swings can be highly deceptive and exaggerated.
Right, and if the price does begin to slide toward those lower psychological floors, what then?
The recommendation is a strategy of installment buying.
How does that work in practice?
Well, the sources provide a practical framework. Say you have a set amount of capital you want to allocate to gold. Say you plan to buy one tail of gold. Do not deploy all your money at once.
Divide that capital into multiple smaller purchases.
Exactly. Execute them at different price points as the market fluctuates.
So, instead of trying to catch a falling knife, which is what most amateur investors do when they try to perfectly time the absolute bottom of a market, think of installment buying like slowly walking down the stairs.
Or testing the temperature of a bath.
Yeah. You don't dive headfirst into a dark pool when you don't know how deep or how cold the water is. You dip a toe in.
Right. You establish a small foothold.
And if the market drops further, you ease a little more capital in, lowering your average cost. It mitigates the shock and is infinitely safer for long-term capital management.
Testing the bathwater is the exact mindset required right now. It prevents the catastrophic error of deploying all your capital hours before a major unexpected drop.
But there is another, perhaps more insidious trap the bulletin warns investors about, isn't there?
There is. Selling your current holdings simply to, quote, wait for a lower price.
This is the danger of the domestic price difference. I think a lot of people misunderstand how this actually works in practice.
It is a really common mistake.
What does the domestic premium actually do to an investor trying to outsmart the market?
It is a critical mechanical detail. When you watch the financial news, you are looking at the global spot price, the paper price of gold traded on massive international exchanges.
Right.
But when you buy or sell physical gold, you are dealing with a local dealer who charges a premium over that spot price.
To cover their own overhead, insurance, and their profit margin.
Exactly. So let's say you sell your physical gold today because you are certain the global paper price will drop by $50 next week.
You think you're being a genius stepping out of the market to buy back in cheaper?
But you are ignoring the local spread.
Yeah.
Even if the global paper price drops exactly like you predicted, your local dealer's premium might widen due to physical supply constraints.
Or their buyback rate might suddenly become highly unfavorable.
Exactly. Because of that domestic price difference, the physical gold hasn't actually become cheaper for you to acquire. You might find yourself entirely unable to buy back your original position without losing money.
You essentially lock yourself out of the market trying to time a microscopic type.
You try to step over dollars to pick up dimes, and you end up tripping over the dealer spread.
That is a brilliant way to put it, which is why the ultimate underlined advice of the June 21st bulletin is to prioritize risk management and capital allocation over the illusion of market prediction.
Stop trying to guess the tops and bottoms.
Plain and simple.
If you are forced to be a short-term player, you must obsessively watch the United States dollar index and bond yields before committing capital.
But if you are a long-term investor,
Your focus should simply be on diversifying your positions, ignoring the daily noise, and letting the long-term upward cycle do its work.
okay, let's bring all these threads together for everyone. We have navigated the complex currents of the June 21st snapshot.
We covered a lot of ground today.
We did. For everyone listening, here is the synthesis of today's deep dive. We are looking at a precious metals market that is effectively being held hostage by macroeconomic gravity. It is locked down by a hawkish Federal Reserve, surging short-term bond yields, and a strong dollar. And this mathematical reality is temporarily blinding the market to the very real, highly volatile geopolitical risks bubbling in the Middle East.
Very well summarized.
Gold is vulnerable, and silver, despite its industrial strength, is ultimately tethered to gold's fate. The required mindset for this specific phase of the market is extreme patience, installment buying, and a flat-out refusal to panic over short-term volatility.
Test the bathwater. Manage the risk. Let the algorithms fight over the daily pennies while you focus on the broader horizon.
Spot on. But before we wrap up today's deep dive, we want to leave you, the listener, with one final thread to pull on, something to mull over as you watch these traditional markets wrestle with modern forces.
It is a big question.
It is. We have spent this entire discussion focusing on physical gold and silver as the definitive safe havens against a surging dollar.
It is the ancient playbook. The rules of that playbook have governed finance for centuries.
But as the digital age rapidly accelerates, we have to ask ourselves, how long will these ancient metals hold an absolute monopoly on that safe haven status?
Yeah. What happens when a decentralized digital alternative begins performing the exact same function?
Acting as a non-yielding, mathematically scarce hedge against inflation that doesn't require physical storage or dealer premiums, does the traditional tug-of-war we analyze today even survive the next decade?
Or are we watching the final days of an analog safe haven operating in a digital world?
It is the existential question for the future of commodities. What happens when the ultimate insurance policy is no longer buried in a vault but written in code?
A massive paradigm shift to keep your eye on.
Absolutely. Well, thank you so much for joining us to share your insights today. It has been brilliant.
My pleasure. Thanks for having me.
And thank you all for joining us for this deep dive into the June 21st Market Bulletin. Don't forget to like this video, subscribe to the channel, and leave a comment below with your thoughts on all of this. Keep observing the currents, keep questioning the consensus, and most importantly, don't let the lack of immediate momentum make you abandon your long-term strategy. We will catch you on the next deep dive.